Well, good afternoon, investors. Welcome to the May 28th, day after Memorial Day edition of Bull Sessions. My name is Mark Robertson. I am joined here by my dear colleague, Ken Kabula from a few miles to the north. How are you doing today, sir?
I am doing just great, Mark. We're going to take off on vacation in a couple of days. I'm going to be at the next bull session next Tuesday, wherever we're coming from, provided the mountain doesn't get in the way of the signal. But we're going to go down to the mountains, Natalie and my most favorite place in the entire world, and we're not even taking computers with it, except for the bull session on Tuesday afternoon.
Oh, fantastic. We have a very special place in the mountains for all of us. Well, thanks. And joining us also is Matt Spielman. Matt is also on the panel for tonight's roundtable. Good afternoon, Matt.
Yeah, even knowing what I'm going to cover, I'm still on again. Okay, that's good. It'll be a slightly shorter version.
Okay.
I
Well,
forgot to warn you guys beforehand. I'm on, and of course it's warm in Houston, but the thunderstorms are rolling in. So I do have my UPS, but if I disappear suddenly, it's not a matter of censorship or intervention.
yeah, we've had a little bit of that ourselves here recently, so we can definitely relate. All right, so we a little over a year ago, I think it was, maybe a little bit longer than that, we have had the Dogecoin dog on our cover slide, and the actual dog that was the inspiration for that coin. Maybe we'll talk about Semler and Bitcoin here in a few minutes, but that dog actually passed away, so we're actually giving him a quick tribute. All right, so we're going to take a look at some. We'll continue to talk about the convention. Matt was just talking about in the green room a little bit about his first experience and the power of meeting some of these people and sharing ideas. What's your biggest takeaway, Matt?
Gosh, that's a hard one. I'll say I was pleased as punch. I was amazed, first of all, that my class finished on time, like almost to the second. But I also took away.
You might not have been the only one, Matt. Okay.
Hey, you weren't there, so you don't get it.
I was there.
I was challenged by the BIVA board for 4bits and also for our own club education on fitting it into a 15-minute section. And I took it down from an hour to 45. I thought that was a miracle, but I came away with a very clear way to make it sort of modular and have a way to do it in different venues. So I was quite happy with that right away. And that was Friday morning. So by the time Friday morning was done, I was just a convention attendee, so I could relax the whole time.
Cool. Good stuff. All right. And then we're going to take a little bit of a look at one of the features of the stock selection guide as promulgated over the last several decades and the zoning that is done during the study of a stock. So anything else here, Ken, that you would like to kick around, or shall we roll?
I wouldn't mind spending just 2 or 3 minutes on Semler Scientific sometime before the period's over, Mark, okay?
Okay, I do not have an update on our best small companies, and that's one of them, because you've given me a rationing budget for those.
Well, I can do my take on Semler in 30 seconds if you want when we get to an appropriate place, okay?
All right, well, let's go ahead and get the other stuff out of the way, and then we can launch with that perhaps. All right, so here is perhaps the last time you see it. I'll probably use it tonight too, because that was a magical moment when Ken actually experienced a Portillo's hot dog. This is just our weekly reminder that Portillo's is not a sponsor of this session, although they should be. And I believe they are under $10 a share, so shares are on sale out there for those that would be interested. And then just a quick look at some of the contributors that happened to be there for the Saturday night dinner. We didn't capture everybody, but that motley crew has contributed to other roundtables, bull sessions, or other panel discussions at the National Association of Better Investing and Manifest Investing. So it's a good bunch. And yes, Matt's the tall guy, second from the right in the back. All right. Here is our standard disclaimer. No investment recommendation is intended. Everything that we do here is for the illustration and demonstration and education intended to share the lessons learned of nearly 8 decades with the modern investment club movement, specifically the discovery and study of individual stocks and the construction of well-designed portfolios. So you will hear opinions from us, our interpretation of those lessons that we share, those ideas that we share, but please do your own homework before making any decision. If we own something, we'll try to remember to disclose that. But again, when it comes to investing related resources, we think you're smart enough to figure that out on your own. Our 2 email addresses are there at the bottom of the page. We do have a roundtable tonight. So this will probably be a slightly shorter session. Time will tell. But we do
If
have
you'd
that
like to
tonight.
come to tonight's roundtable, drop me an email by, let's say, 4:30 or 5 o'clock this afternoon, and I will be glad to send you a link to the roundtable where you can register and then attend. That's going to start at 8 o'clock. That's a new starting time for us at roundtable, 8 o'clock, and that'll be until further notice, 8 p.m. Eastern time.
Okay. Here's a quick look at the stock market as we generally do. The green bars are the stock market average as measured by the average of the stocks in the value line standard edition. So you can see we're kind of back at a fairly normal condition. The manifest investing average return forecast is hovering right around 9%. Value line is slightly higher than that, checking in at about 9.7%, but again, without getting too fine about it, we're looking at fairly normal return forecasts. A little bit fewer stocks that would register as being on sale these days, and you can see that the farthest green bar on the right has returned to that long-term trend line, as shown here. Anything else here, sir?
Well, just I've met a couple of people that have the chart just a little bit backwards. When that green line falls below that blue line, that's when there's a lot more stocks for you to take a look at as possible purchases. When that green line moves significantly above that blue line, that's where it becomes more difficult to find stocks that perhaps are going to end up in the buy zone on your SSG.
Yeah, and probably the most dramatic example of that was back at the financial crisis of 2008, 2009. You can see that the white gap down below got fairly large. It was pretty easy to find stocks on sale at that particular point in time. Same is true here with COVID. So when the green bar dips down below, that's when everything is pretty much on sale from our perspective. All right. Well, let's go ahead and just jump into the Groundhog Challenge. We do have a new leader, and it's Ellen Hall. And Ellen, I don't know if you knew this, Ken, but she is one of very few people that have been around for every single year of the contest. And she is in the all-time Hall of Fame with a positive relative return for her 17 years. So it's nice to see her up at the top. And of course, your name, you skipped right by her to your own name being on the list there. As most people do. I got letters this morning from people because I posted this in the forum just for a quick update, and people sent me emails. Where's my name? Did I make some kind of mistake? And I had to point out that they were farther down the list with me and lots of other people.
Believe me, it happens. I know all about it.
But Kim is up there. I think Matt is just off the list again with me. And we saw many of these people in Chicago also. The Mobley family from Pennsylvania, and just a number of people. And again, it's good to see so many clubs, including some of those repeat champions. And as Ken pointed out, the Wolves are back on here, as our B.I. Baker here, 2 local clubs.
And the cool kids.
And the cool kids, ever dangerous. Kathy Wood has dropped down to 171st, but the Monkey has soared to 63rd, which means he's about 22 places ahead of me now. So not good.
It's disheartening, isn't it, Mark?
It is when you can't beat a handful of darts. It's tough to take. We get it most years. All right, here's just a quick look at the status of our 7 most widely followed companies that manifest. They are at the top of the chart. They are not there by any particular accident, and they basically have good long-term track records. Investing Roundtable, which we will do tonight, has returned to almost a 5% relative return. That is our ambition and our objective. And you can see the indices are continuing to behave fairly well. I do watch for this one to maybe catch a little bit of fire again before the end of the year, and hope to see that one kind of catch up and restore itself, because normally it would be at the top of those indices on display there. Anything else here, Ken?
No, I continue to talk with people about this list, and they're amazed when I explain where those 7 names come from. So I think it's a great example of relatively well-known, normal kinds of stocks performing extraordinarily well over long periods of time.
Yep, and many of us own several of those companies, and I know that, for example, Microsoft is near the top of our personal assets for sure.
Well, I used to own all 7, Mark. I only own 6 of them now, but I will leave it to the investor public to ferret out which one I sold, okay?
Boy, I can't imagine which one you would have sold. Maybe Fastenal.
My
But
lips are sealed.
your lips are sealed. All right, here's our reminder. We publish this a couple of times a month, where we're basically looking at the companies, the institutions, and their mutual funds and exchange traded funds that have the best track record over the trailing 10 years. That's measured by the relative return in the far right-hand column. Their actual annualized total return is the third column from the right. And of course, the comparison is between that and the Wilshire 5000, the benchmark return down the middle. So again, this is just our reminder, and I hope you guys don't get tired of hearing it. Growth matters. When you look at these funds, we track about 650 funds. These are the top 20. They do not change a lot. They drift around a little bit, but you find a high quality fund with a sufficient growth rate and decent returns, and you're setting yourself up for some pretty good things. And we use it as a source of ideas.
We spoke in southeastern Michigan about 2 months ago, and that relative return column with 5% or better relative return only had 12 candidates, and now it's up to 14. So they might be moving up the list a little bit. They're doing a little bit better than they had previously.
Yep. And we've seen that get as low as 6 or 7, above 5%.
Yeah, absolutely, absolutely.
The other one on here that's really interesting is Barron Partners was second, but I believe 60% of their assets are in Tesla. So that took them almost off the list very quickly when Tesla hit a dare I say, speed bump. I guess I just did.
I'm still surprised by that number 19 on there, Mark, and I can't really seem to come up with a reason why that kind of growth is yielding this kind of return. I'm having trouble with that one.
Yeah, we're going to go deeper into that. We have started to reconcile some of the differences in the operating margin, so I expect to see that 14 number come down closer to the 8.
Well, that's the only number that sticks out on the prove list there. So yeah.
Yeah, and I think it's just a matter of some high operating margin estimates from a couple of different places. All right. Here's just a quick reminder. We covered the topic of projected return on enterprise value in Chicago fairly extensively. I will probably do an encore presentation of the early stage investing, and this was a big part of that. A few of you went home and tried to use this on financial companies like Schwab and had a little bit of trouble recreating what we had put on the screen. I just wanted to remind that the formula for asset-based companies is slightly different, and the slight difference is we use book value instead of total liabilities minus cash. And the reason for that is pretty simple. When it comes to asset-based companies, those two categories get kind of crazy. So we want to stick to that bottom line. This is our answer to the modified Greenblatt version of this formula. And just want to make sure that for asset-based companies, any place where we basically are gauging the company based on its book value and return on equity, you want to be using this instead of the other industrial formula. So two different formulas.
Yep, Mark, I worked with a woman about, I don't know, 3 or 4 weeks ago. And folks, when we talk about insurance companies, insurance brokers are completely different. When Mark says insurance companies, he's talking about people that actually underwrite the insurance. He's not talking about people that might sell the insurance. Two very different business models. And a broker, an insurance broker, people that just sell insurance can be evaluated with the other proof formula fairly easily.
Yeah, and another example would be like Visa. Visa is not treated as an asset-based company.
Absolutely.
You know, Visa is a member of that other industrial class. So it's pretty
Yep.
straightforward. Lot of buzz on this, and I answered a lot of questions on it, and I think people need to go away and think about it very carefully.
Yeah, the insurance company that we were working on, if somebody's wondering what an example would be, was Brown and Brown. I think
Yes,
that's the
yes.
name of it. Yeah.
Yep, Brown and Brown has been a long time community favorite. It was featured in
Yeah, and
Better Investing quite a while ago.
it's a broker, not an underwriter.
Right. So again, more like a merchant.
Visa,
Yeah.
right? A Visa rather than a Wells Fargo. Yeah.
Service provider. Yes.
Yeah.
All right. So we're going to spend some time talking about stock analysis, stock studies, and this is an area that we delved into a little bit when I did our update on better selling. Ken and I had done a version of this a few years ago, and we have put some of those techniques and nudges on display with the roundtable tracking portfolio. We'll probably be doing more of that fairly soon as the fall approaches. But you know, I'm a huge fan of the stock selection guide. Goes all the way back to the mid 1990s when I encouraged our investment club to get as deep an understanding of, you know, what's behind the sections of the stock selection guide, what's important, what are the milestones, and all that kind of stuff. So don't take any of this the wrong way. I basically have the highest esteem and regard for that tool. There are some areas though where I think that improvements can be pursued or at least considered. So again, I'm not saying anything nasty about it, but just as an example, everything that we do at Manifest Investing, every single stock study is basically a preferred procedure deployment or implementation. So that's just an example of how we use it for everything. And this is an area that came up. We're going to explore this in some detail. That I think that we believe that the characteristics of the company should influence your not just your selling decision, but your buying decision. Fair enough, Ken?
Absolutely, Mark. There's I think we're just talking about how sophisticated an investor you eventually want to become, and I think we're dealing with some things that you wouldn't ever expect to sit down and try to discuss with somebody just starting the journey. But once you've been on the journey for 2 or 3 years, I think you deserve to grow and to consider other things besides just a set of rules that have helped you do fairly well. I always think you can learn something and you can do better than you had been doing if what you're learning is contributing to the total return of your portfolio. So I think that some of those things that Mark's going to talk about and that I will talk about in the future, I think are are things that should be considered and, dare I say, talked about in any type of a situation, but especially in these situations where we're dealing with more sophisticated investors. This bull session audience is not made up for the most part of beginners.
Oh,
It's
not at
made up
all.
of people. It's made up of people with a long history of understanding the SSG, and then going beyond that tool, and not being afraid to take in the best things from any other tool that happens to be available that can help.
Yeah, and I was pleasantly surprised that Cy went into such level of detail in his portfolio centered class. In fact, one of the things he touched on was this notion of a single stock with a 15% return forecast. You know, you've got it and it's in the buy zone, but you'd look and let's say the total stock market average return is 18 or 20%. Um, you don't want to ignore that. You don't want to ignore the fact that your stock study result is something you ought to scratch your head over a little bit. Ken and I have both witnessed this with investment clubs. You know, you walk in and they say, well, we've only generated an 8% return. And you guys have all heard this story, so I'll do the nutshell version. We pointed out to that particular club that the stock market return over that same period of time was only 4%. So, you know, to not achieve a 10 or a 12 or a 15% return, getting 8, but when the market is only up 4%, they were actually setting the place on fire. And it went from a funeral to a party. And so keeping those things in context, whether they're individual stocks or the total portfolio centered thing, um, very important stuff. Context. Context matters. Here's just a quick reminder that we really do believe that the most important tool when it comes to managing the portfolio are the individual stock selection guide results. And the results of every stock study are basically what you get for a return forecast at the end of your study. Now, we actually plot the chronicle of monthly study results. In this case, you can see Costco there. And the squiggly red line would be a snapshot capture of that average return forecast every month for the last 5 years. And we think that that also can be very telling. The quality is the blue line up at the top there. And again, commercial. Kurt did fix it so that that legend does not obscure on the live website. So I've gotten a number of notes from you guys that you frankly love that.
Got a standing ovation from a lot of folks, Mark, when he did that. Okay.
It did. It definitely did. So this is the thing to keep in mind. That is the output of every stock study is what do you expect for a return? Quality
Well,
matters. Go ahead, Ken.
and dare I say, Mark, when you find a really high quality company like a Costco or an O'Reilly Automotive, and you folks know that that list is fairly short, but when you find a company like that, maybe you buy it when the returns are out of the ordinary on the high side, and you don't spend as much time agonizing over whether it's just into the hold zone or just into the buy zone. I think that's the kind of discussion that we're trying to have. Maybe there are never going to be times when Costco is a solid buy on a well done SSG, but maybe there are times like Mark just marked on that sheet there when Costco is telling you, I don't hit this point very often. It might be a good time to put some shares away for the future.
Absolutely. So you want to be mindful of that. It's just important to recognize that. Cy actually asked the audience, is there a time when you should consider a company with perhaps a 12% return? And I'm going to tell yet another FactSet research story here in a few minutes. All right, so here was the slide which caused a little bit of head scratching. Beth Ham was in the audience. She did not tell me what she thought of this slide, but I'm just basically asking the question. And as we do the traditional zoning in a traditional stock selection guide, this range is actually formed by extrapolating some PE data, price to earnings data, and basically creating a spread or a range based on price to earnings ratios. And as you really dig into the math behind it, I basically ask that three-part question. As you're doing a stock study right next to another stock study and comparing the two, the company quality really does not enter into this aspect of the guide except where it influences the PE characteristics. And basically, this particular aspect of the guide, I'm not saying it's wrong or it can't be improved, but again, I want to encourage everybody to keep it in context and perhaps de-emphasize it a little bit, because it really does not account for company quality. It also does not do what we were just talking about. What if the average market return right now is 22%? What if it's 6? And this does not actually track that in any way, and it also does not include the influence or impact of dividends. And I really think it should, even though back in the days when the stock selection guide was first created and invented, the average dividend yield was somewhere in the 4 to 6% range. And obviously, it's much different than that today. But what Nicholson actually did, and again, I say this with the utmost admiration and in recognition, Ken talks about slide rules and the lack of calculators and the lack of just simply information. It would take you months in some cases to get the data for a stock selection guide, back in the 1940s, back in the 1950s. And so Nicholson had to come up with a way, and he did it with this extrapolation of PE ratio characteristics to come up with a way to look at a stock in isolation, literally with blinders on. Kind of a myopic type concept, but it was absolutely ingenious and it works. That said, we think that you should take that information and very carefully consider it with the average return forecast. We really think that is the output of a stock study. So we're going to cover some of the ways that we deal with this now, share some things. Did a little bit of automation this weekend, Ken. What are your thoughts from 35,000 feet?
Well, this blinders idea, I used an analogy in beginners classes that I teach, and I talk about horses and racing, and many horses wear blinders when they race because they have to be kind of focused on a very narrow place in front of them, and the blinders that we kind of use, or the
Uh-oh.
with PE values to try to help us forecast the future history. But we do find a lot of horses that run better without blinders, and maybe there are bowlers that would bowl better without gutters. I don't know. But sometimes I think that starting fresh and doing some thinking about the future doesn't necessarily have to depend on everything that was happening in the last 5 years in the past. That might be too circuitous a route for some people to have to follow to basically be told to think on your own sometimes. But that's exactly what we're saying, that in order to come up with a reasonable SSG, sometimes you have to think on your own, and sometimes you have to walk away from what the history says, and you have to walk away from what 80% of the stock selection guides in the past have told you to do, because you're looking at something that's completely different from what you have usually been testing. When you deal with a company, for example, where you can't hope to estimate what the sales growth is going to be, how in the world do you hope to estimate what the earnings growth is going to be, or what the PE ratios are going to be in 5 years, in even 3 years, in even 1 year, when we're dealing with some of these high-tech companies? Maybe we need a little bit of leeway when it comes to creating our studies and doing our analysis for a lot of these companies that are out there.
So what we're going to literally talk about is this notion of, we actually do zoning, but we do it in a much different way. We are driven by the return forecasts, and that's what sets these two conditions over here for us. And we're going to describe that and show how we basically come around to the same thing from a completely different angle, but uh, something that is more in tune to the three characteristics that you see up above there. Here's actually a slide from Cy Lynch's presentation. Like I said, he covered this stuff pretty carefully. And his whole point that he was attempting to make with the audience is he believes, and I believe Ken does too, that many of us in the community pay too much attention to the buy, hold, or sell output of a stock selection guide, perhaps without paying sufficient attention to the Section 5 total return. So that's what Cy is basically drawing some attention to here, that you basically want to focus in on those total return characteristics. And frankly, it's the most important aspect of a stock study. We've been teaching it that way for 30 or 40 years. Any comments, sir?
Well, I don't want to wade into the swamp of rules, so I'll just say there aren't nearly as many rules concerning Section 5 of the stock selection guide as there are concerning Section 3. There's a lot of rules that tie people in knots sometimes when it comes to Section 3, and I've heard them all. But you get down to Section 5, and people have already fixed in their mind that it's a buy, a hold, or a sell. And Section 5 a lot of times doesn't have as much weight as it should. Sometimes it has no weight in the final consideration of what to do.
Considering in the early
It should have a lot of weight, I guess, is the conclusion.
Section 5 didn't even exist on their early computerized tools, so there you go.
Yeah.
Cy also pointed out that this notion of not looking so much at the individual stocks, considering them to be basically a team, and the overall impact of what the team averages are. So centering the portfolio on those overall portfolio weighted averages. And he pointed out this is not something that's new. In fact, Nicholson used to do a weighted average of some of the portfolio characteristics for the mutual club. It was in the investor's manual back in the 1970s. So we have been doing a form of this. And as Cy points out, just again, not so much attention on the individual stock buy, hold, or sell indication or suggestion, but more along the lines of what does it do for the portfolio? How does it impact the overall team? This is nothing new. We do this all the time.
Even our current tool on the summary report gives us weighted averages for some of these values up at the very top. I know it's ignored by many people that read that report, but if you're using the current SSG Plus tool and you're using the SSG summary tool, take a look at what's up on the banner that includes all the column headings. Look up there at some of those values because they're useful and they're important. And I think they get to the root of portfolio-centered management. Maybe they don't go far enough. Maybe we should be pressing for more measurements, but you have a couple of them right on that report to start with right now.
And of course, we do have the quality definition that's defined by an index or a ranking. And I don't believe that is something that really is available at the tool yet, but wouldn't be surprised to see some form of it attempt to be developed over the years. But on our dashboards, you do get that quality ranking. All right, so when you're looking at any company, and here we just use FactSet Research as an example, happens to be a company currently somewhere around a 10% projected annual return. What I wanted to make the point is that the selling return is based on the core characteristics. In other words, we talk about selling a stock based on whether it's very high quality or core at a lower number than the average stock. And in this case, this is a very high quality, very high core score with these three characteristics checking in pretty high. So we would want to hang on if you're making a single decision. You're just talking about buy, hold, or sell on FactSet. You would want to demand that the selling return, the price be at a point such that the selling return is fairly close to zero, or money market rates if you want to go that way. But money market rates have actually shot up into the 5% range. So in this case, I would override, basically say I want to sell at a zero return. What price would give me a zero return? That's where the 682 comes from. $682 is the price that would generate a zero return. Company's currently at 434, so it's got a ways to go to get there. Buy below price is the same thing. We do basically think about companies, whether they're core or non-core. If it's a core stock, I'm generally going to be looking for the market average, which we said at the start was 9 or 10%, to be 5% above that. In the case of FactSet, I might settle for a little bit less, as was suggested by Cy. And that gives you the price of where you'd want to buy below to achieve that return. Any questions on this, Ken?
No, you're talking to the choir, Mark. It's how I buy and sell stocks that I'm not breaking all the rules on. So
Okay. All right, and then this one is a golden rule. It's one that I spent a little bit of time in the better selling class in Chicago, and it's important. A lot of times these type of companies can be tough to study, tough to reach some conclusions about, but once you're in and you have one of these, we talked about Netflix being one of those type of companies, tough to hang on to. NVIDIA, as recently as a year ago, was about 1/4 of its current price. So you have some real volatility there. I think this is an important rule. Or
one of the other ones
maybe I
that
should say
comes to mind
suggestion.
one of the other ones that comes to mind that I made a huge mistake on is Meta, the old Facebook. That if I would have reminded myself that I put this very paragraph into a lot of my teaching materials, I should have read it myself and been a little bit slow to sell Meta when it took its huge crash about a year and a half ago, only to rebound in magnificent fashion.
So again, the impact on what we're thinking about here, the selling return that you would go after for a high quality company is going to be, probably close to zero for companies that exhibit these type of characteristics. And you're going to think through and say, okay, this is a rapidly growing stock. Maybe I drive this down to zero instead of 5, or even the market average somewhere around 9 for a non-core stock. You want to force it to be a little bit more difficult to sell. Give it more leash when it fits this characteristic. All right, and this is a fun slide. Here's Apple, our most widely followed company, and you can see the summary there. Sales growth rate somewhere in that upper single digits right now. Quality is pegged at close to perfection. The projected annual return is somewhere in kind of mid-range for the last several years. As close to as upstairs in parallel as you can get for a company that's this ambitious, large, and still fairly fast growing. So again, our purchasing and our selling decisions are influenced by what you see here. Very high financial strength, very high stability of earnings, and a very high quality ranking. So this is among the top core scores out there. You can only get 300. It's pretty close to the average. So you can see that is the total picture. You have some idea of how this fluctuates over time. You can see that back here, somewhere around mid 2020, the projected annual return did approach zero. I don't think it quite got there, but it came pretty close. And again, this is a company, even though it's more volatile than many, the highest projected annual return didn't reach 15% over this 5-year period. So again, that's kind of a point to notice and something you want to think about. What is interesting is the selling return. And again, think about this notion of the conditions under which you would consider selling a stock are a function of what you think of the company, whether it's core or non-core, if its growth rate is greater than 10%, or if it's non-core all the way out on the right. So this is kind of a sliding scale. So setting the selling return along this kind of a sliding scale perfectly demonstrates that, if you're treating this as a high growth core company, you're talking about waiting to sell it in the upper 200s. It's currently at 175. But if you're treating it, if it's a company that would be regarded or treated as non-core, look how much lower it is. Just selling at nominal market rates right now, money market rates. So I think it makes the point that the quality of the company and the situation with the general stock market can influence that selling return. Your thoughts, sir?
I'm just going to say that I agree with everything you're saying, Mark, and leave it at that.
Okay. Easy enough. So then we basically are setting up to automate this, and it'll show up on the pages as shown here. Here's my FactSet story. Again, it's a company that's projected annual return does not reach into double digits very often. So anytime that it does, it might be worth some attention. It's a good company. It's an excellent company. Not growing at over 10%, but pretty close. And again, the condition, the characteristics, the quality, the core attributes of the company are what are setting these conditions down here. So this $436 stock, I would not consider selling until it approached a selling return of 0. That would be reached under current conditions at about 682. And that will float around with changes in the market or changes in the company quality. So that's another FactSet story. We had a number of FactSet stories from the panel, opening panel discussion, Let's Talk Stocks in Chicago.
Mark, what I use FactSet for when I teach, and again, especially when I'm teaching beginners, is to just drive home the fact that earnings follows sales and stock price follows earnings. And if you don't believe it, look at FactSet sales and earnings lines. They're just about as parallel as you can make them. And that means they're growing at approximately the same rate. And the stock price should basically be following that same general trend in an upward direction at approximately that same slope. And you can look at those price bars there, and if you kind of squint, you can say to yourself, well, yep, that's what's happening, all right.
Good. It's a great model for that. All right, is Matt still with us, or did we lose him to the thunderstorm?
I'm here. No, I'm here.
Matt, would you like to share your thoughts on how Morningstar is capturing this sentiment a little bit?
Sure. Well, having a preview to what was coming here, had a few thoughts in my mind. There's really three thoughts. And I totally agree with what you guys said, but I do go back to the genius of the upside downside ratio. You think about in 1979, Danny Kahneman and Amos Tversky published their findings on prospect theory to actually quantify how much we fear a loss over wanting a gain, fear versus greed. Came out to 2.5, and they won a Nobel Prize for that.
Right.
Think of how many years earlier that was and how close. I'm really curious how much intuition was there versus discussions with others or other, because this is not in investing or only investing. This is in personal consumption in a lot of contexts. That's been essentially confirmed. So a really interesting viewpoint early on and some important research. The second thing is just as a correlation to this, I think, Ken, you mentioned taking it into context rather than that being your primary method. When we did the study on Joel Tillinghast, and I'll put one more plug in because his book's only on sale at the end of the month. You can get it for $3 off Amazon. That's Big Money Think Small. He has so many compatible thoughts in better investing, but using his own language. He actually uses upside downside. But in his mind, if you are like us, like Warren Buffett, where your ideal holding period is forever, The upside downside are not potential prices, but actual prices that will occur sometime in the future. Think about that in the terms of Netflix, the ups and downs of Netflix, or for those more recently, the ups and downs of Shockwave we had. Those aren't something to think about, well, maybe, or what it is. Those are kind of gut checks to say, what would you do when it is that point or not? So, I think that gives some context to, this might be a high reward stock. It might be high risk too. And that gets into Morningstar. That brought me to do a little bit of research on this. Morningstar, of course, ranks stocks by 5 stars. The 1 star is colored red, meaning it's bad, or it would be sell, their view of sell, and the 5 stars buy. But they also, on the x-axis, they have what they call uncertainty. So that is not necessarily a quality metric, but it is influenced by what they call moat. So they award stocks a wide moat, a narrow moat, or no moat, meaning the cumulative competitive advantages, which has quite an overlap with our view of quality, although a lot of cyclical companies can have wide moats too. And so wide moat companies tend to be on the left with lower uncertainty. Of course, if you go through periods like the pandemic, everybody gets somewhat higher. And of course, no moat companies get high uncertainty. And so they have this kind of banding in a much greater range when they basically forced themselves to admit what they know and don't know. And there are some things like Procter & Gamble or Walmart, which are relatively straightforward to find out about. There's plenty of other opinions about it. There's a lot of data published. Where if you have an early stage company or a very niche company, maybe it doesn't have any analysts following it yet. No matter what numbers you plug into, what formulas you might have, you probably don't know a lot about it. And so they very explicitly make both decisions further out, right? The buy price gets lower compared to what their calculated fair value is. Well, we might say the average par is. And their sell price gets much higher because they know they don't know, if you will. I'm not saying I recommend what this is, and there is no exhaustive explanation of how they came to these numbers that are fairly even numbers, if you will, suspiciously even, but okay, it's a framework. But this is kind of a mental model to think about what you would go through or not. And that it's not a fact set story, but I think back to the April stock panel, my pick for Perion Network, which is a very small fish in a big pond of online advertising. Just went through a big business loss because one of their largest partners changed their pricing model. And when I came and looked through any of the options to calculate a low price, they still expect somewhat of continuance in the future of what happened in the past. I didn't find that satisfying. It was about 1270, 1290 at the time. One of them was 11 something, one of them was 10 something. I said, I don't think that's risky enough. I think that's pretty easy for a company that isn't in a war zone but is next to a war zone. And so that's where I went, where I said I went full Ben Graham, went to liquidation value. And I thought that was the only way to really be pessimistic enough to judge what my projected return would be.
So we'll have a liquidation value on the selection low price.
Matt, do you view the paragraph at the bottom as a little bit of hedging, which says we're going to give you our rules and then agree to break them whenever we think it's necessary?
Yeah, and that's kind of like, I mean, even Value Line, where you get kind of a middling par and it says this is a great opportunity, right? The analyst words don't necessarily follow through with the calculation, but to their credit, they show both.
Yep.
You can decide which one you trust more.
It's just good lessons for understanding that all data sources have uncertainty attached to them, and data sources don't necessarily have to agree and often don't agree with each other even, let alone with what we would like to think about's happening.
So again, what I think this demonstrates is looking at the companies differently based on their characteristics. And I'd be surprised I didn't look for the information that's probably in the report. The lion's share of their companies probably do end up in that section right there, medium uncertainty. And I suspect it's a fairly small population out on the far right. So it might be kind of interesting to look at that, but it definitely guides our thinking on or influences our thinking on some of this type of stuff too.
Mark, this is a technical issue. Are you using a headset right now?
I am.
Yeah, you're having some difficulty breaking up off and on. So we might be having some problems with that particular headset. I don't know.
Yeah, I think it's the whole Comcast feed to the house.
Okay,
Based on
that
our
that
recent
could be
times.
as well.
So let's go ahead and wrap up real quickly. Here's just a quick look at the Buttonwood Bulls portfolio. We're not going to select a stock today, but we will be finishing it out here in the next few weeks, and it's actually going along quite well. All those starting positions were 162.50, so you can see many of them are ahead of where they started.
So enough money to buy 2 more positions then, right?
Yep.
Okay.
So we'll be doing that soon. And then Matt wanted to check out one of his slides for tonight and see if we can actually make this run. And I don't know, Matt,
All
if we can
right.
actually,
Click
if I just click on,
I think you
Yeah.
just click it once, Mark. Yeah.
Yeah, just like advancing a slide or something else.
all right. So
I guess I can hear it. It's a little jittery, but I think it comes through.
yeah, I can hear it
There's a
just a little bit. Yeah.
Well, and it doesn't even need the sound to be effective, Mark.
No, I mean,
It's
like the audience in Chicago just went, ooh.
yeah. All right. Could I spend 20 seconds on Semler before we wind it up?
Yeah, is this a graphic of similar or no?
No, this is not Semler. This is
Okay,
something else.
go ahead.
Semler Scientific is on our best small companies list, and we were quite optimistic about Semler. It makes a device that can test for PAD, that's peripheral artery disease, and that's a very undiagnosed, underdiagnosed, and undiagnosed problem that many people have, many more that are being treated for it have. It causes problems in your legs and occasionally throughout different parts of your body. It's closely related to some of the heart blockage problems that exist in some people. And Semler has a test that's very non-invasive, can be done in a doctor's office, does not require a certified technician to run it, is not something you have to go to a special location to have done. You can do it sitting across the desk from your doctor, in fact. What happened with Semler is that when the Medicare reimbursement came out about 2 months ago, the code to allow doctors to code for this particular test was missing from the code book. And the question was whether that was an omission by a commission or omission in error. And they were getting some help in trying to determine whether that was going to be replaced in the code book. United Healthcare has a very vested interest in getting this put into the code book, because if you can diagnose PAD early, you can begin to help treat it, and the cost of healthcare then goes down significantly for that particular problem that you might have. Semler today is up about 40% in its stock price, and it has nothing to do with anything that I just said. But Semler this morning announced that it was putting all of its spare cash, or most of its spare cash, into Bitcoin. And I'm afraid the back of my mind is saying, is this going to become a meme stock? Is this the poster child for people betting on something completely unrelated to the business model that I placed my money into Semler for in the first place? I know that my Mid-Michigan Model Club is going to have a serious discussion about this when they next meet, because we decided to buy some Semler at a low price, thinking that the chances were good that the code would go back into the Medicare reimbursement book and that Semler stock would rebound from a very steep fall earlier in the year when it was discovered the code wasn't there. I don't know what to make of this recent gain in Semler stock. All I know is that my club is back to where it bought the stock and then some, and they're doing that without the reason for the rebound that we expected to happen. So with all that being said, I think if you own Semlers, you should at least make yourself knowledgeable about what's happening. And if you don't own Semler, I don't think the time is now, unless you truly identify it as pure speculation. I don't think the time is right now for you to put money into this stock that suddenly has a large holding in Bitcoin. That's all I'll say. I don't want to get into a Bitcoin discussion with any of you about cryptocurrency. I will just say that I'm a non-believer, and it's very difficult to change non-believers' beliefs, whatever they happen to be. So I'm a non-believer and probably will continue to stay a non-believer in cryptocurrency. If you are a believer, then I appreciate your position, and I appreciate your religion and everything else. I just am not going to buy into it.
And we
So with that
appreciate
being
you.
said, Mark, you can close down, okay?
Yeah, you're not the only skeptic out there. You're in company. All right, just a reminder that we do archive all of these sessions, whether they're roundtables, bull sessions, or other educational sessions, on YouTube under Manifest Investing. If you subscribe, we'll let you know when new content is added. Here is our reminder that we're going to dig into this here over the next few weeks. Here is a quick screening result. Ken, I basically said, show me the software application, the IT people, engineering, construction, and I threw consulting services in there and said I want quality of 80, financial strength of 70. Pretty good list to start with, and start searching for a good industry study population for sure.
I will tell you, Mark, that this list right here helped me decide to sell one of those top 7 stocks that was on our list earlier in the program. I think Joe Whitaker is asking us a great question to maybe begin our next session or the session after with the question, and he wants to know, what's the purpose of the Buttonwood portfolio? I think it's a great question to begin one of our sessions with as we begin to play with it a little bit and try to illustrate some things that we think are important.
Mostly fun, Joe, but just to demonstrate some of the portfolio management stuff. All right, can anybody name that Vista? Came to us from Ann Manning and her vacation travels recently.
I don't know. Banff?
Close. Crater Lake
I'm
in
close.
Oregon.
Okay. Crater Lake. Okay. All right.
Beautiful area. And Ann checks in from Crater Lake, said it was absolutely breathtaking. All right, so with that, anything else in the hopper, Ken?
Nothing right now, but we do have that roundtable this evening. Starting time 8 o'clock. If you come at 8:30, you miss the first half hour. So we'd love to have you with us at 8 o'clock. And we're going to have a great presentation on a stock that has really piqued the interest of many, many, many of the people at Bink, and maybe it'll pique the interest of some of you folks as well. We're going to talk about ticker symbol LAZR. And I'll leave it to you to look it up and see what the name of the company is.
Fantastic. All right, see everybody tonight. Thanks, everybody. Take care.